In today's Property Insider chat, Dr. Andrew Wilson and I give you an update into the latest My Housing Market rental report, and there's no relief for tenants in sight. We also talk about some latest data that will give us a bit of a clue to what's ahead, including the latest building approval figures and retail sales. And of course, as always, we discuss the auction results to give an in-time indication of how our housing markets are performing. If you want to keep up to date with the latest property data, please subscribe to this YouTube channel and click the little bell icon so we can inform you each time a new show comes out. Australia is a nation obsessed with house prices, and according to a recent survey by Westpac Bank, about 60% of people are planning to buy a home or a new home, upgrade, downgrade in the next 5 years. Yet the heartbreaking battle facing first home buyers is getting harder, with rents skyrocketing. And last week we reported My Housing Market's end of April figures showing that property prices have continued rising around Australia. That's 16 months in a row now. But in today's Property Insider chat with Australia's leading housing economist, Dr. Andrew Wilson, I'm keen to see the latest My Housing Market rental report, as well as discussing some of the latest data that'll give us clues as to what's ahead for our economy, interest rates, and our housing markets. Hi, Andrew.
Yeah, good day, Michael. Another month passes and we have another rent report. Some interesting results this month when we've seen really another upward shift in vacancy rates. So generally, not all markets, of course, but that trend is sort of continuing, but without trying to, I guess, announce that this is a precursor for better news for tenants. I think that we've got a few ifs and buts and maybes ahead of us regardless. And I do think the April results were to some degree affected by the holiday month that April is, which can have an impact on demand and therefore have a few more vacancies. But without, sort of heralding the end of the rental crisis, I think once we do look at those vacancy rates, particularly for houses, they're still very, very low.
Well, it's said that a balanced housing rental market is around 2% vacancy, where there's enough properties for tenants to have some choice and enough tenants around for landlords to be able to choose a tenant appropriate for their property. But currently, with vacancy rates hovering around 1%, a bit more, a bit less, really there's such a long queue for any vacant property available at the moment that it still is a landlord's market.
Oh, absolutely, Michael. And as I said, we've seen an upward trend over April in vacancy rates, perhaps reflecting maybe a bit more supply coming through. I doubt that, but maybe a little bit less demand because of those holiday distractions. But most markets actually recorded for houses a higher vacancy rate over April. And yet, if we look at the markets which had a higher vacancy rate, Sydney and Melbourne vacancy rates were up, so was Hobart, Perth and Adelaide. But when we look at the actual vacancy rate, Sydney vacancy rates is still just 0.9%, Melbourne 0.8%, and Adelaide and Perth, which also had increases in vacancy rates, there it's just 0.5% each, Michael. So
Wow.
I don't think there's very good news there. And we look at the trend, yeah, okay, it's better news to have more choices, but when choices are so few, in just about all capital city markets. I mean, the outlier there is Hobart and Darwin, and their vacancy rates are 1.1%. And as you mentioned, with our sort of balanced market measure at around 2%, we're half of that with the best performers from the tenants' point of view of Hobart and Darwin. And those that have had easing vacancy rates are still very, very low. In fact, these are record low levels, Michael. And so no really good news there for house vacancy rates that, although have eased, are still very, very low.
Well, let's go through the figures. Let's look what's happening with the housing rental market at the moment, Andrew.
Well, look, a big shift in Sydney over the month, Michael. Sydney now up, and this is the point, even though the vacancy rate increased just at 0.9% is still putting upward pressure on rents. And Sydney median house rents, Michael, are now at $800 a week, which it's not that long ago where we had the Sydney median house rent at $500 a week, and that's a 2.6% increase over the month and 12% higher over the year. I mean, rents were mixed. We had Melbourne, Adelaide, and Darwin and Hobart were flat over the month. But we had Brisbane, which is really building up ahead of steam in its rental market, up by 1.6%. And as I mentioned, Sydney up by 2.6%. We had Perth down 1.5% and Canberra down 0.2%. So a little bit up and down there, but certainly, these rents are still historically high, and those vacancy rates are remaining low. I'm not sure we're going to see any relief, sustained relief for rents for houses anytime soon.
With house rents going up, many people are looking to trade backyards for balconies and courtyards. What's happening to the unit market rentals around
Well,
Australia?
as we sort of mentioned last month, Michael, it seems to go in waves of one or the other. And as you said, perhaps affordability drives over 1 month or 2 month period drives prospective tenants from units to houses, looking for more accommodation, more bedrooms, perhaps. But then when rents rise accordingly as with extra demand, the affordability factor then shifts back towards the typically more affordable unit market. And we did see overall rents increasing for units over the month. Again, mixed results. We saw Brisbane up by 0.4%, Adelaide up 0.5%. Perth was also up by 0.4%, but Sydney, Darwin and Canberra were flat over the month. Melbourne down by 0.4% over the month. And look, Melbourne's been picking up quite strongly. It's a unit market, so perhaps a bit of consolidation there. And Hobart,
Considering, Andrew, it was the strongest unit rental market over the year with 16.3% growth, the Melbourne market is allowed to catch its breath, isn't it?
well, absolutely. And this again moves back to those affordability constraints. You can't keep people are used to a certain factor, I guess, in terms of their rental contributions from their income. And as that rises steeply, even though their incomes, might be similar to other capitals, they still need some breathing space to catch up. I think that's what we see in Melbourne. But Melbourne's still certainly significantly affordable compared to most of the other major capitals for units. Particularly Sydney, which is tracking at $750 a week, and also Brisbane at $630 a week. So, Melbourne, although growing, still has some catch up to do in terms of relative position with Brisbane and Sydney. But you're right, 16.3% increase in Melbourne over the past year. That's a heavy load to carry for tenants over a 12-month period, Michael, in terms of an increase. Brisbane also up 14.5%. And Adelaide up 14.9%. So, again, we saw vacancy rates increasing for the unit market over the month. The vacancy rates are higher for units compared to houses. We have Brisbane, Melbourne and Sydney all above 1%. Also Hobart, Darwin and Canberra. And only Adelaide and Perth have a vacancy rate under 1% now for units. So maybe a little bit of a light at the end of the tunnel for the unit market, unit rental market, Michael. But certainly these vacancy rates are still low, not as low as houses, but certainly do continue to reflect, a landlord's market and lots of competition amongst tenants for available properties.
With little new supply coming onto the market, it could well be that the holiday distractions over April with Easter and school holidays has affected the housing market, the vacancy, the tenant market in April. And also there's anecdotal evidence that people are staying at home with their parents longer, moving back to their parents, or having more people in their households, which was a trend that was the opposite over COVID. So a number of factors affecting our rental market. We'll keep a track of that each month. We also had some reports in that will make a difference to what's ahead for our interest rate and our inflationary environment. Retail sales are one of the things we keep a track of. The Reserve Bank looks at, of course, too, wanting to see what's the consumer sentiment. Are we spending? Are we pushing up the value of goods and services, Andrew?
Well, we had the latest retail sales data released by the ABS for March, and we did see an easing down by 0.4% over the month, but retail sales are still tracking just above where they were a year ago, Michael, up by 0.8%. And that increase followed a 0.3% rise over February. And of course, the ABS was said that 0.3% rise over February was contributed to by the Taylor Swift effect, if we could
Yes.
use that as I suppose, any excuse, but yeah, the Taylor Swift effect. So if we did have this Taylor Swift effect over February, we've had a sort of an adjustment because we sadly don't have Taylor Swift in the country at the current time. So retail sales, yes, down by 0.4%, still higher than they were a year ago, as I said, Michael, and certainly well ahead of the pre-COVID period. In fact, still tracking around 40% higher than where retail sales were, the value of retail sales were prior to COVID. And of course, the stimulus packages, caused an explosion in retail spending, in consumer activity, and that's what they were designed to do. So in a way, when we're looking over the past 12, 18 months of activity in the retail market, it is highly inflated by those stimulus packages. So to still be, tracking at those levels, I think reflects still quite strong consumerism. But there's no doubt that the rate of growth, that the trend is starting to ease. And we shouldn't be surprised at that, of course, with particularly, higher inflation and, a lot of those savings that were accrued during COVID have now dissipated. So still a strong result, but certainly the trend is starting to ease. And look, that'll be taken as a positive sign from the Reserve Bank in terms of, easing consumer activity and therefore, hopefully from their perspective, downward pressure on prices.
Well, also over the week, the latest house building approval figures came out. We're hoping that we're going to be building more houses to alleviate the housing crisis. What did the figures show?
Well, we had some positive news after a couple of months of quite insipid activity from home building. Home building approvals are up by 3.7%, and that followed a 3.5% fall over February. But the ups and downs of building approvals, Michael, really have reflected the volatility in the unit market.
Yes.
We do tend to see volatile results from month to month in terms of the unit building market because, we can get a very big development coming through. And of course, that elevates the overall result. And of course, the following month, if we don't have that same big development, then we get a sort of a lower number, obviously, as an adjustment. So that 3.7% was quite interesting because it wasn't really a factor, as we've seen, of those bouncing around of the unit market. It was actually units were up 3.6% and houses up 3.8%. So it was quite a consistent result from that point of view. Total homes, Victoria was the best result there, with total homes up by 3.2%. But if we looked a little closer at the state breakdowns, they were actually lower, Michael. So it was really Victoria and some of the smaller states that elevated that overall result. And so I don't think, we can herald the end of the housing crisis in terms of lack of supply just on this month's numbers, but certainly it's better to have a positive result going forward, particularly one that's not necessarily, certainly the headline data is not necessarily reflecting, the volatility in the unit market.
As we always say, though, Andrew, it's not just the building approvals, but they've got to come out of the ground. And despite the will of the government to get home building activity moving, there just seem to be too many obstacles in the way. Chronic trade shortages, planning and licensing delays, industrial relation changes that are causing some problems. Material costs are inflating. You give us a regular report on that. At the moment, the fact that most lending is unfeasible, new projects are not financially viable at the moment. So I think this is making most new projects unsustainable. They're not going to come out of the ground anytime soon.
Well, that's right, Michael. And approvals for apartments typically won't translate into, a dwelling or somewhere to live for 2, maybe 3 years. And as you said, there are plenty of constraints that may be, elongating that particular time frame. Building approvals are good, but they're really a sign of what's to come, in the future. And when we're coming, even if we start to revive, when we look at the trends, they're really just bouncing along the bottom, and no real sign of an increase in the the trend line. And when we look over the year, the past year, we can see that houses are down 9%, units are down nearly 15%, and overall dwellings down by 11% over the first 3 months of this year, Michael, compared to the same period last year. So even though we've had a much more positive month this month over March, we're still well behind where we were a year ago. And particularly for units, we know we had a surge from the previous government's home builder package in house approvals, but that's certainly worked through the system now. But it's units which are continuing to underperform. In fact, Michael, when we look at those capital city results, just to sort of emphasise, the long-term decline in housing supply in Australia, capital city home building approvals are down by nearly 40% since their 2016 peak, Michael. And that trend may be just starting to steady. This is the annual trend that we're looking at. Is still, nowhere near what we would expect to be comfortable with in terms of matching supply and demand. And when we look at the unit trend, the annual trend for capital city unit approvals, they're down by 56%, Michael. Now tracking, the annual trend is now tracking under 50,000 a year for units, capital city units, which is well below the 110,000 trend that we had at the peak in 2016. And as I said, Michael, this is what's going to happen in 2 or 3 years. So those unit approvals are telling us that we're still going to be undersupplied chronically in 2 or 3 years, even if we get a revival, which is unlikely in the near term. So not so good news there when we look at building approvals. But the interesting thing is that Melbourne still is the epicentre of building activity. Total homes nearly or just under 9,000 over this year to March, and well above any of the other capitals. And maybe that's part of the reason why we haven't seen the level of prices growth that we've seen in other capital cities, Michael, is the fact that Melbourne has a better supply line going forward. But Melbourne units are now falling again below Sydney. Melbourne have approved just over 3,000 units for building so far this year. Sydney's at 3,700. So Sydney's, and we've seen that with some big developments affecting the overall building approval data from month to month coming out of Sydney. Sydney's certainly taking the lead again in terms of apartment development, but as we see with the rental market, it's not having an effect in terms of rents, and we shouldn't expect that because, as I mentioned, these approvals won't translate into on the ground dwellings unit approvals for at least a couple of years, Michael.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with my team at Metropole to discuss your goals, your options? We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. At Metropole, we're big enough to tip the scales in your favour, but still small enough to care. And since we don't sell any properties, our advice is independent and unbiased. Now remember, property investments are a process, not an event. So you can't just go out and buy any property and hope to be successful. In fact, now more than ever, the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. Well, no relief in sight for tenants, as we said a couple of minutes ago, and much the same for people wanting to get into the housing market. Lack of supply and more of us wanting to buy houses means property values are just going to keep moving up. But what's going to happen in the short term? Well, that's why we have a look at auction results each week to get an idea of what's happening on the ground, how buyers and sellers are feeling. April was a funny month for auctions, Andrew, because of all the distractions.
Yeah.
We've had the first weekend in May, but some of that's still a bit of a hangover with a long weekend in Queensland this last weekend, and people still just coming back from holidays. But how did the weekend go with auctions?
Well, yes, look, we're now moving into the second part of the autumn selling season, Michael. And of course, that really runs into June. So it runs into winter, into the seasonal measures of autumn, and then we move into winter. So it usually starts to dissipate, as we get towards the end of June and move into July. But so the market, as you said, it's just starting to settle now after what we see every year, a very disruptive month, April, where we do have particularly sellers are distracted by holidays. Agents don't want to conflict the market with with the holiday distractions. So we certainly always see fewer listings coming forward generally through April. So we really need the first or second weekend in May to start to get back to what we call a normalised market, and then it runs through, as I said, for 6 or so weeks, and then we can get a real sense of the underlying nature of the market. But look, we had some reasonably steady results again to begin the month, but we're continuing to see, which has been interesting this year, Michael, and as you mentioned, we're continuing to see a higher or buying activity. People are still obviously happy to buy, but we're also seeing a surge in seller activity this year. In fact, over the first or over the period so far this year, we've seen a record number of auctions conducted, Michael, record number of listings. We're also seeing a record number of sales. So even though vacancy or clearance rates, haven't been as strong as they were a year ago, they've still been strong enough to produce a record number of auction sales. So, that validates what you were saying before in relation to that there's plenty of buyer appetite for activity out there in the marketplace. And we saw that again on the weekend. In fact, there was a good result in Sydney, just coming back from school holidays in New South Wales. 744 auctions, no surprise, well above the weekend before. 74% clearance rate is quite a strong result, Michael, and the strongest for a couple of weekends. But again, just reinforcing the position of the market now compared to a year ago. It was the numbers of auctions were well ahead of where they were for the same weekend last year. Melbourne also back in town, 985 auctions. Auction clearance rates a little bit down, but still tracking in those mid-60s. Again, similar to Sydney, Michael. Look at the difference between the auctions a year ago in Melbourne over the same weekend compared to this last weekend. Nearly 50% more auctions conducted. And Brisbane, holiday weekend, as you mentioned, fewer auctions, clearance rate a little higher, but that bounces around that Brisbane clearance rate. Adelaide, steady result there, similar auctions, a little bit higher at clearance rate, similar. Canberra down a little bit. We've been looking for a revival or calling a revival in that Canberra market over the past month or so. A little disappointing there because it's gone against that recent trend. But maybe, coming back from holidays, a big auction weekend there in Canberra added to that lower result. But overall, similar results that we've seen through the holiday period, Michael. But as I said, we're seeing certainly Melbourne and Sydney significant increases in the number of listings, and clearance rates have been such that we're seeing, because listings have been so high, record numbers of sales. So I just want to reiterate that we're now moving in, as I said, to the second half of the final part of the autumn selling season. This was a very strong period, breakout period a year ago, Michael, in all our capital city markets, which started to record very strong clearance rates as sellers started to move back into the market following that the hiatus, I guess we call it, during 2022. And so we're not going to see those same levels of clearance rates in our capital city markets. Maybe Sydney could be an exception given last week's results. So it'll be interesting to see if we continue to see those high numbers of listings coming through. So still quite a vibrant market, Michael, but certainly the prospects are that it won't be as strong overall as it was a year ago, but that was almost a boom time market and clearly a catch-up market. And when we look at the annual results, we can start seeing that the Sydney market, although had a good result so far in May, which of course was last weekend, 74.9, still below where it was overall in May last year, when it was actually tracking at nearly 80% clearance rates. Same story in Melbourne a year ago, nearly 80%, but well down on that. Brisbane also lower than where it was a year ago so far, and Adelaide lower again, same old story, and the same story with Canberra. So these are trends that we'll likely see continue, Michael. But the point is that with high numbers of listings, record high numbers of listings to this point, we're still seeing very significant numbers of sales being conducted. So it's not necessarily just about the clearance rate, is it? It's also about the number of properties being sold and what that's doing to prices. And as we saw with our last week's house price report or home price report for April, prices are continuing to rise, even without those significant clearance rates of a year ago. So look, interesting results there for the auction market to begin the month. And of course, you can get those snapshot results of the capital cities every Saturday at 6:30 p.m. on my LinkedIn site. And the full national report, which Michael publishes, is also available on Sundays on my LinkedIn account. And that includes the regional breakdowns for Melbourne and Sydney, and also the top 10 sales for each of the capital cities in the auction market. So we, of course, have a big week coming up, Michael, with the Reserve Bank's interest rate decision. And I'm sure we'll have plenty to discuss in relation to that decision next week.
Well, the market started strongly this year. There was the anticipation that interest rates were going to fall, so people were wanting to get set. Clearly, that expectation has changed over the last couple of months, but it still seems that buyers and sellers are out in the market there making their moves despite what the anticipation is of interest rates. So look forward to catching up with you next week to hear all that's happening in our housing markets. Thanks, Andrew.
Yeah, thanks, Michael. Thanks.